Bismillahirrahmanirrahim. Assalamu alaikum. I am Abdul Adamu. This lecture is on risk and return. It is the part 2 of our lecture on risk and return. In the first part, we look at risk and return of a single investment. In this part, we are going to look at risk and return of a portfolio investment. Kindly help us to subscribe to our YouTube channel, which is dataanalytica.com, and also click the notification bell so that whenever we drop any content, you get it. Also share our video. Now this part 2 is on portfolio investment. Now a portfolio is a combination of financial assets or investment. Unlike the single investment where an investor only invests their earning on one asset, for portfolio the assets of an investor is divided into among different assets. For instance, if we look at this pie chart, the pie chart represents investments in different companies: Dangote Cement, BUA, ET, Academy, Access, ICO, Airtel. This, if we add the total amount invested here, this will amount to 4 million. Out of the 4 million, 800,000 is invested in Dangote Cement, 450,000 is in BUA, and so on up to Airtel, which has an investment of 2 million naira. So now this investment, if we go back to our pie chart, you can see that Airtel, with 50% of the investment, that is 2 million out of 4 million, has the higher proportion. Then Dangote Cement 20%, BUA 11%, ET, Academy, Access, down to ICO, which has 1%. So this is a typical representation of a portfolio. So this shows that investors rarely place their entire wealth into a single asset or investment. What they do is they construct a portfolio or group of investment. Now if you look at this table, you see that each of the investment, if we consider them as a single investment or individual asset, they have their returns. Dangote Cement has a return of 0.67, BUA 0.25, 0.32, down to Airtel, which has a return of 0.74. Now this weight is a proportion of investment of the total investment in each of the assets. For Dangote Cement, the 0.2 of the total investment is in Dangote Cement. For BUA, 0.113, and so on. Then Airtel, which has 2 million. 2 million out of 4 million is 50%. It has 0.5%. So this weight is, when we take individual investment in an asset, we divide it by the total investment. That is how we got this weight. Now, how do we calculate expected return of a portfolio? Now, to calculate expected return of the portfolio, all we do is we multiply the weight of each of the assets by its return. If we go back, you can see Dangote Cement has a weight of 0.2, the return is 0.67. BUA 0.25 return, the weight is 0.113. So we multiply each of them and add them together. So when we multiply, we add them together, then we have the return of a portfolio. So the W you are seeing here is the weight, or the proportion of the amount invested in the asset. Then the weight, when you add all the weights, if you add all this weight, it must be equal to 1. It must be equal to 1. If we go to our Excel, this is the weight. If we add alt equal, so you can see it's equal to 1. So that is the weight. Then to calculate the expected return for this, all we do is we multiply this by this plus this times this. So if we go to our next Excel, you can see they calculate expected return, all we do 0.2 times 0.67, that is for Dangote, 0.25 times 0.113, and so on like that, up to 0.5 times 0.74, which is for Airtel. So once we multiply it, we add them together, we are going to get 0.5830, which is approximately 58.3%. So assuming we have a portfolio, if we before we go to that, let's go to our Excel and demonstrate that. So we multiply this by this, that is equals to this times this. Enter, that is the value. Then we copy it down, relative referencing. So those are the multiplication. Then we add them together to get the expected return. So we use Alt equal, enter, that is 0.5830. So this confirms the value that we are having here. So let's take another example, using that our Dangote and BUA that we have been using from a single investment. So if a portfolio consists of those two stocks and 30% of the investment is in Dangote, 70% is in BUA, what is the individual return? We have calculated the individual return before by adding all these 6 for Dangote and divide it by 6. We calculate for BUA also, we add all divided by 6. This is the computation. When we add all this return, we have this, divided by 6, we have this. You can see these are in percent, this is in decimal. So we have converted the returns to decimal before we made our computation. So when we do that, we get our return. So if you come here, you can see the return for Dangote is this, the return for BUA is this. So these are their weight. Dangote is 30%, BUA is 70%. So once we multiply this by this, we get this. We multiply this by this, we get this. So we add them together, then the return for the portfolio will be 0.1412. So that is exactly what we have done here. 0.3 times 0.0087 plus 0.7 times 0.198. So when we add them together, we have 14.12%. So if we go to our Excel, you can see the value. To get the return for each of them, we use the average function, equal average of this, enter. So that is the value. Then we can just copy it here, relative referencing, that is the value. So they are down here automatically. Then our weight for Dangote is 0.3, for BUA is 0.7. That is our value. So once we multiply this times this, and this times this, so we have that. Once we add the two together, you can see is the sum of these two. Our return is 0.1412, which is the value we have here. So the next item is portfolio risk. Now portfolio risk can be measured using variance or standard deviation, as we have learned for a single investment. But the risk of a portfolio is normally affected by 3 factors. The first is the risk of individual security. Now, if we look at the individual security from this portfolio, their risk depends. For Dangote Cement, the risk is high. For BUA Cement, the risk is low. For Eti, the risk is high. Academy, low. Like that, Airtel, high. So if you select a portfolio, if you select stocks in your portfolio that the average risk is high, it means the portfolio risk will be high. If the average risk is low, it means the risk of the portfolio will be low. If you miss those high and low, then you'll be able to enjoy diversification. So that is one factor that affects portfolio. Each of the assets have their individual standard deviation, which is a measure of risk. The second aspect is the weight of the investment. What is the proportion of the amount you have invested in that portfolio? Your total investment, what is the proportion? So if you look for Dangote Cement, 0.2 is the proportion. For Bua Cement, 0.113, down to Airtel, which has 50% of the weight of the investment in the proportion. So a portfolio risk is also affected by the weight of the investment. Another factor that affects portfolio risk also is the degree of diversification between the stock. What we mean is the co-movement. The stocks in the portfolio, how do they move together? How do they co-move together? Some stock, when the return is high, the risk also is high. So some stock, when their risk is high, the risk of the other stock in the portfolio could be low. So it means they co-move in opposite direction. So this co-movement, which is the measure of diversification, is measured using covariance or correlation coefficient. So before we will be able to compute the risk of a portfolio, we need to compute the covariance, how the stocks in the portfolio, how do they co-move together, by either finding the covariance or the correlation coefficient. So for selecting portfolio, those three factors are very, very key. So individual risk of the security, the weight of the investment, and the degree of diversification between the stock. So we are going to, before we do covariance and correlation, let's take a hypothetical example of portfolio selection. Assuming you have $100,000 which you want to invest, you have three options. One, you have an option to invest it in a single stock of Google. So this portfolio is a single investment and there is no diversification. So you can also choose to invest it in either Google, Microsoft, Apple, and Intel. So this investment is in one sector. It is a portfolio, but it is in one sector, so it is not well diversified, because if anything happens to the sector, then your investment will be affected. So because these stocks, they are highly correlated. And the third option is either to make your investment in Google, Deutsche Bank, American Airlines, Target. So if you make investment in these four stocks, they are in different sectors. This is a portfolio, then they are well diversified because there will be a low correlation between them. So the important thing to consider is, one, the degree of correlation between the stocks in your portfolio, and also this will give you whether the portfolio is highly diversified or not. And if it is highly diversified, you'll be able to reduce the risk efficiently. So this goes to tell us about the English expression which says, don't put all your eggs in one basket, which means that don't make everything dependent only on one thing. If you look at this investment in option B, it's dependent on the activities in the IT sector. But this is not dependent on only one sector, but on different sectors. This is dependent only on the single investment that you have made. So before we compute the portfolio risk, we need to do our measures of association. We need to do covariance or correlation. Now, what is covariance? Covariance measures the degree to which two variables move together. So if for two stocks, if we want to compute the covariance, it is just the difference between the expected return and those individual returns for stock X and that of stock Y. You multiply them together, you add them, then you divide it by n-1 degree of freedom. So if it is a probability data, you subtract the return from the individual return multiply them and multiply it by the probability and sum them together. So for historical data, if you find your covariance and the value is positive, that is greater than 0, it means the two stock, x and y, they move in the same direction, meaning as x increases, y also increases. Then if it is less than 0, meaning if it is negative, it means they move in opposite direction, meaning as x increases, y decreases. Then if it is equals to 0, it means they show no tendency of moving together. So we should note that the covariance does not show the degree by which these two variables x and y varies together. So the measure of association that shows that is the correlation coefficient. But before we get to correlation coefficient, for our stock Dangote and BUA, let us find the covariance of the two stock. So if you remember, this is our return. These are our returns from that. These are our return. So the first thing we do is to calculate the average, which we have done earlier. If you go back, you will see that we have computed the average for Dangote is 0.0087, for BUA is 0.198. So if you subtract this average from each of these returns, so to get the value here for Dangote, 0.205 minus 0.0198, you get this. So for each of them, you subtract the average to get this value here. For this, you subtract 0.133 minus 0.198 to get this value. Subtract 0.198 from all to get this value. So then you multiply this by this to get this value. When you sum them together, you have minus 0.100. Then you divide it by n minus 1 degree of freedom. Our n is 6. So 6 minus 1. So our covariance is minus 0.0199. So this means there is a negative relationship between Dangote and BUA. As the return for Dangote increases, the return for BUA decreases. As the return for BUA increases, the return for Dangote also decreases. So let's go to our Excel and see how these computations are made. So if we come here, we can see the average we got earlier are this. The average we got earlier for Dangote is this, for BUA is this. So for each of them, you subtract those average from return. So this is equals to this minus the average. So we are going to lock it, since we will copy it down, F4 to lock it. So that put this dollar sign, enter. So we have this value, so we are going to copy it down. We copy it down. So this is the value. So you can see this minus this. You can see so it went to capture a different thing. So this is this minus this also. So we do that for BUA also, equal this minus the average, F4 to lock it, enter. That is the value. We copy it down. That is the value. So you can check and see that is correct. Let's check this and see that is also correct. So we go and find their product, that is this times this. So this is equal this times this, enter. That is the value. We just copy it down. That is relative referencing. So that is it. You can see it's multiply it well. Now we sum it using alt equal or sum function. That is the sum, enter. That is the value. Then the covariance is equal to this divide by 6 minus 1 bracket close, enter. And that is the same value we have. Now this covariance, we can use the covariance function in Excel to find it. So let me do the covariance function here, equal covariance S. We are doing sample data, so double click. Then our array 1 is Dangote. We copy all, comma. Array 2 is Bua. Then we close the bracket, enter. You can see the value is the same. So that is, we can use our covariance function in Excel. So this is how we can compute our covariance. Now the next thing is correlation coefficient. Now for correlation coefficient, it's used to measure the degree by which two assets, X and Y, move together. So this can tell you the degree of the relationship, whether it is strong, it is low, it is perfect, or it is zero. So for our Dangote and Bua stock, if we want to compute, if we have two stock X and Y, to find the correlation coefficient, we can now use the covariance, the relationship between that and covariance. So we use the relationship between that and covariance. So the value of our covariance divided by the standard deviation of X times the standard deviation of Y. So the value of regression normally lies between -1 and +1. -1 and +1. So if you look, if it is -1, it is perfect negative correlation, meaning as X increases 100%, Y decreases 100%. Then if it is equals to +1, perfect positive correlation. As S increases 100%, Y also increases 100%, and it could be equals to 0, showing that there is no correlation between them. So the closer the value to +1, we say it's a strong positive correlation. The closer the value to -1 is a strong negative correlation. The closer the value to 0, we say it is a weak correlation. So from this relationship here, if we know the value of our correlation, we can also find the value of our covariance. So by multiplying this standard deviation by the correlation. So if we take our covariance value, which is -0.0199, we divide it by the standard deviation of Dangote and standard deviation of Bua. When we divide, we see that our value of the correlation coefficient is -0.32, which is a moderate relationship between X and Y. As S increases, Y decreases. So if we go to our Excel, we can take those values and see. We said this is equals to our covariance value. We can take any of them, divide by, bracket open, our standard deviation for Dangote times our standard deviation for Bua, bracket close, enter, and that is the answer we got, -0.32. So if we use the Corel function in Excel, equals to Corel. Now array 1 is Dangote, comma, array 2 is Bua, bracket close, enter. So that is the same value. So you can select any one first, you get the same answer. Let me demonstrate. Equals to Corel, array 1 Bua, comma, array 2 Dangote, enter. You can see the answer is the same. So we can, anyone you select as the first array, the correlation between them will also be the same. The same thing goes with the covariance. Now that we have our covariance and correlation, we are now equipped to do the portfolio risk. Now to do the portfolio risk, first variance. To do that of variance, all we need is we multiply the weight, we square the weight times the variance of each of them plus the weight times the covariance, the weight times the covariance. So don't just forget the how this is determined. We have the formula that is determined here and the way we can do it using the matrix method. So for variance, the weight of x square multiplied by the variance plus the weight of y square multiplied by the variance plus 2 times the weight of x, weight of y, then you multiply by the covariance. This is why we are looking for the covariance. So if it is 3 stock, it's fairly long. So, and to get our standard deviation, all you do is to take the square root of the variance. So the higher the value for the standard deviation, the more riskier the portfolio. For variance, don't forget we said we cannot put a unit of measurement to it because of the square before we get the value. So you have to convert it to standard deviation before you can say whether the risk is high or the risk is low. Now if we use the matrix method, you can see we have 2 stock. The 2 are here, Dangote, Bua, Dangote, Bua. Now the weight of Dangote here, that is why we have this WD. Then the standard deviation of the 2, Dangote, that is why we have these 2 standard deviation. So here the weight of Dangote, the weight of Bua. Standard deviation of Dangote, standard deviation of Bua. That gave us the covariance of the 2 of them. So the same thing here and the same thing here. So if you look, this gives us W square, Dangote square, which is this. This gives us this square, which is this variance. If you look at this, WD, WB covariance, WD, WB covariance. These are 2 of them. That is why we have this factor here. Then WB, that is square. Then the variance, that is this. This is how you can use. So if you have 3-4 stocks in a portfolio, you can easily use the matrix method to be able to determine the formula for the variance that you use. So to get the standard deviation, you take the square root as we stated earlier. So now the next thing we'll do is we are going to do our computation for the portfolio variance and standard deviation, assuming the weight for Dangote is 30% and the weight for Bua is 70%. Before we go on, please don't forget to subscribe to our YouTube channel and click the notification bell so that when we drop any content, you will be notified. Now, thank you. Let's continue. Now, you can recall that the weight, we say 30% is 0.3. Weight of Bua is 0.7. The standard the variance, which we have computed before, we have computed the variance before. Anyway, we have computed the variance before. Let me go to the Excel and show us. This is the variance and this is the variance for Bua. Now if those are the value which we have computed, then we have done the covariance also before. Look at the value of the covariance here. This is the value of the covariance. Now that we are equipped with that, we can now put it in our formula. We can put that in our formula. So W square, that is 0.3 square, multiplied by the variance, which is this, that is the value here, plus 0.7 square, that is the weight for Bua, multiplied by the variance of Bua, which is this, plus 2 times weight, 0.3, 0.7 times their covariance, which is this. When we multiply them, we have this value, and add them, we have 0.02880, which is the variance of the portfolio. So this cannot be interpreted easily. Like we said, we cannot put unit of measurement to it. Then we need to do the standard deviation. So for the standard deviation, we take the square root of 0.0288, so that is the square root, which is the variance. So which we have 0.1697, and once we convert it to percent, is 16.97%. So if we go to our Excel, we can do this. We have all those values present here, you can see, so we can do it in our Excel. So for variance, we said equal wx square, that is this value, we say square. Let me put bracket, this raised to power 2, bracket close, times the variance. Our variance is this, bracket close, plus this raised to power 2 times our variance. The second variance is this, plus 2 times our W1 times the second weight, which is this. So press enter. 0.4572. I think something is not right, so I think it's from here too. So let me start all over again. Delete equals to our W raised to power 2, bracket close, times our variance, which is this, close, plus 70% raised to power 2 times our variance also, plus 2 times 30% times 70% times the covariance. I think that was the problem, so this is the covariance. So enter 0.0288. If you compare, that is the value we have here. So the standard deviation is the square root of that, equals to SQRT, that is square root of this value. Enter 0.1697, 0.1697. that confirm our value. So that confirm our portfolio variance. So we can see that is how we do the portfolio variance and portfolio standard deviation. So now the next item that we'll look at finally before we end this lecture is the issue of the diversification effect. Now earlier when we talked about those factors that affect portfolio, we said there are 3 of them: the individual security risk, the weight of the investment, and the degree of diversification. So for a portfolio, we enjoy diversification. So how do we measure this diversification effect? Now if you look, when we computed the return of a portfolio, we multiply the weight of the portfolio and by the return of each of the assets. So let me go back to there. So the weight times the return. But for the portfolio risk, we did not multiply like that because of the covariance between the stock. That means when one stock risk is high and the other one is low, it has the tendency of reducing the risk. So that is why we don't multiply. So assuming we find portfolio risk by multiplying the weight times the standard deviation. For Dangote and Boa, let's multiply the weighted, let's find the weighted standard deviation. So the weight is 0.3 for Dangote and the standard deviation is this. So when we multiply this by this plus that of BUA, we have 25.17%. You can see clearly that this risk, if we take the weighted standard deviation, is far higher than the weight of the portfolio, which we computed earlier, which is 16.97%. 25.17% is far higher than 16.97%. So this reduction is probably due to diversification because of the negative correlation between the two stocks. Now, if this is due to the negative correlation, then that means there will be less benefit from diversification if the two securities exhibit positive correlation. Now, if they exhibit positive correlation, then how high is the positive correlation before all the diversification benefits vanish? How high? So let's try to demonstrate and see how high it will be. The highest value of correlation is +1. So let's go back to our formula on portfolio variance. If we come back to our formula on portfolio variance, we can see we have a covariance here. If we want to bring correlation coefficient here, we can use the relationship which we expressed earlier. The covariance is equals to correlation times the standard deviation of the two stocks. So if we bring that, we can change our covariance to correlation times the standard deviation of Dangote and the standard deviation of BUA. We represent it in our formula on variance, where we say 2 times weight of Dangote, weight of BUA. Instead of covariance, we now represented it by this. So assuming the correlation coefficient is equals to +1, that is the highest value of correlation. So if we substitute with those values that we have done earlier, we substitute in the correlation variance. So once we substitute 3%, this is the variance like that. But when we come here, this way times this way, this is correlation coefficient. So that is the +1 here. That is the +1 here. Then multiply by the standard deviation of Dangote and standard deviation of BUA. So once we add them, we have 0.0633. And we take the standard deviation, we have 0.0633, which give us the standard deviation of 25.17, which is the same or almost the same as when we find the weighted standard deviation of Dangote and BUA. So that means as long as the correlation value is less than 1, the portfolio risk will be less than the weighted standard deviation of the individual security. So in other words, it means that the diversification effects apply as long as there is less than perfect correlation. So this is the end of this lecture. I want to implore us to try to subscribe to our YouTube channel. This will enable us to grow, and we should click the notification bell so that whenever we drop any content, we will have access to them on time. So thank you very much for your attention.